You bought your home in 2022 or 2023. Your rate, it's somewhere between 6.5% and 7.5%. You've been watching rates, waiting. They've not dropped the way you hoped. And every month you're making a payment that you know is higher than it should be. And the options your lender has shown you have not changed that. This is the video I wish someone had put in front of you 2 years ago. After 19 years and over 3,700 loans closed in Central Ohio, I've spent most of my career telling clients to avoid adjustable rate mortgages. That advice has changed. And the reason it changed is the number most lenders are not showing you. By the end of this video, you'll know exactly how to determine whether an ARM makes sense for your specific situation and what government-backed versions these products offer that almost no one is explaining. The myth keeping you stuck. Here is what most Central Ohio homeowners believe right now. Adjustable rate mortgages are too risky because the rate can go anywhere. That belief was reasonable in 2008. It's costing people real money in 2026. FHA and VA ARMs are not the products that caused problems 18 years ago. They use a 1-1-5 cap structure. After your fixed period ends, the rate can rise no more than 1% in year one, no more than 1% in any single year after that, and no more than 5% over the life of the loan. So it's not unlimited. 5 points total ever. Your brain was protecting you from a product that no longer exists in its original form. The map you were given was drawn for a different market. That matters because people are paying $150 to $200 more every month right now to avoid a risk that federal regulation is capped. The question is not whether ARMs are risky. The question is whether your specific window in this home matches the product's fixed period, what FHA and VA actually offer. Most lenders do not promote FHA and VA ARM products. They require a real conversation, and there's no particular incentive to start one. Here's what they look like. FHA and VA ARMs are structured as a 5-1 product. It's fixed for 5 years, adjusting once per year after that. They're indexed to the constant maturity treasury rate, not the SOFR like the conventional ARMs. That distinction matters because the CMT index has historically been more stable. The caps are 1-1-5. A conventional often carries a 2-2-5 cap. The first adjustment, you can jump twice as far. The government-backed versions are more conservative at the exact moment of greatest uncertainty. For an FHA-eligible or a VA-eligible borrower sitting at 6.5 or higher right now, this is worth 20 minutes. The current ARM rate sits at 5.6%. The 30-year fixed is 6.37. That spread is 76 basis points. On the Central Ohio median of $315,000, that's $155 a month. Over 5 years, that savings is a big number. I know I just threw a lot of numbers at you. So I want to back up and just tell you what this really means to the average homeowner who's looking for a lower house payment. With the FHA and the VA ARM products, you get a rate right now that's in many cases 1% or even 1.5% lower than where the fixed rates are. The interest rate is going to be fixed for the full 5 years of the initial 5 years of the loan. At the end of 5 years, the interest rate, it cannot change by more than 1%. And in many cases, the rate can actually go down. And with this product, you have a built-in safety valve. You can refinance this product with no requirement for requalification. No appraisal on the property. You don't have to re-verify your income. As long as you've made your last 6 house payments on time, you're automatically eligible to refinance. So for the average home buyer, we're going to save $200-300 a month, and we're going to provide you with a lot of certainty with an opportunity to refinance at any point over the next 5 years. 2 more myths. ARMs are only for people who are moving soon. It makes complete sense you believe this. Adjustable products were marketed for years as short-term tools for people who knew they were leaving. But here's where that framing breaks down. If rates move another 0.5 point lower in the next 18 to 24 months, you're going to refinance anyway. The ARM gets you a lower cost of capital during the hold period and puts you in a stronger cash flow position when you refinance. You're not taking on more risk, you're paying less while you wait for the same outcome. The next myth: this is a product only aggressive lenders pushed. I believed this for much of my career. It made sense to believe it. The ARM's reputation was earned badly, and here's what changed my thinking: the data. When the spread between a 5-year ARM and a 30-year fixed is under a half point, the fixed wins on simplicity. When it approaches a full point or beyond, the math earns a serious conversation. The spread right now is at least 76 basis points. That is the data, not a pitch. It's a number. I worked with a couple last month, 7.25% fixed, and they called me because they were thinking about pulling out of their retirement account just to manage the monthly payment. That is where they were. By moving to the 5-year ARM, their payment dropped by $847 a month, and that's $10,000 a year they were leaving on the table because no one had showed them this option. They found this by watching my YouTube channel. The conversation took 20 minutes. What actually decides the answer? Here is the framework. 3 questions. How long are you realistically in the home? If the honest answer is fewer than 7 years, the ARM's fixed window likely covers your whole period and you're paying a fixed premium that you'll never need. What does your refinance path look like? If rates fall meaningfully in the next 2 to 3 years, you'll refinance regardless of whether you're on a fixed or an ARM. The ARM gets you a lower cost of capital in the interim. 3, what is the actual worst case? With a 115 cap structure, at a maximum a 5-point lifetime increase on a $315,000 balance, your payment rises by roughly $950 at the ceiling. That ceiling is the worst possible outcome. It is not a likely outcome. Most borrowers never approach it. Knowing the number is what makes the decision rational. Start with this before you call anyone. Take your current interest rate, subtract 5.61, multiply by your loan balance, and divide by 1,200. That's your monthly cost of staying on the fixed side compared to today's ARM rate. Write that number down. This is what we can talk through on the call. Central Ohio's median sales price just hit $315,000, up 3.3% year over year. Ohio homeowners are locked in above 7% in 22 and 23 are the most likely candidates for this conversation. If that is you, this option may not be on your lender's radar. It is on ours. One form, 20-minute conversation. You'll leave with the break-even number for your specific loan and a clear answer on whether the ARM makes the most sense for your situation. Not a recommendation to trust, a calculation. Before you go, if you knew your ARM rate could never rise more than 1 point at a time and 5 points over the life of the loan, would you have rolled out an ARM without running the numbers? Tell me in the comments. I read every one.